I remember when I was on Wall Street and I first started to sense what the Federal Reserve was and the role it was playing. But in your evolution as an investor, in your evolution as a student of the markets and somebody studying the structure, when did the Federal Reserve first come onto your radar screen? Because it was a lot later in life than October the 20th, 1987, when Alan Greenspan put out an advisory that the Federal Reserve stood ready to back the banking and financial systems, and within days and weeks was leaking information to Wall Street bond trading desks ahead of Fed moves to inject liquidity in the system. I mean, this is 1987 that the Fed put was born, but I didn't know squat about the Fed until me personally, the run up to the 90s, the dot-com days.
Yeah, so people tend to forget that when Alan Greenspan came on, as you pointed out, he started in August, and by October we had a crisis on our hands, right? So Paul Volcker was viewed as, the greatest Fed chair in history. He had saved America from inflation. Now, I obviously, you may have heard me dispute that, and I have some real questions about those dynamics. But Alan Greenspan did step in 1987 and did something really important. It wasn't so much that he offered to bail out the banking system as what he really did was he facilitated the provision of lines of credit and made good the lines of credit for the market makers, right? The specialist firms. So I mentioned Spear, Leeds and Kellogg, which was the largest specialist firm on the New York Stock Exchange at the time. I actually traded commodities for them. But the challenge that you had as a market maker is that you used large amounts of leverage against a relatively small capital base to facilitate orderly transactions in a then manual order book, where orders would come in and you would actually try to match a buyer and seller. And if there was an inability to match that buyer and seller, you would put your capital up against it. Mm-hmm. And so in the crash of 87, the specialist firms had extended their capital and used borrowed money to buy stocks to try to facilitate a liquid market. As the market fell out from under them, the losses that they faced on those books made their bankers, their banking relationships nervous. They then pulled the credit lines for the specialist firms, which destroyed the liquidity. Effectively, there was no bid at that point.
And Alan Greenspan's in the air, flying home from Dallas. So you've got the head of the New York Stock Exchange. I'm good friends with Arthur Cashin. So I wasn't in the pits at the time, but Arthur Cashin's walked me through that day, but continue.
Yeah, no. So Art Cashin actually is the gentleman responsible for getting a hold of Alan Greenspan and saying, look, this thing is going to go straight to zero unless you guarantee these specialist firms and get these lines of credit back open. That was where Greenspan stepped in and said, okay, listen, we'll make the banking system whole on any losses associated with specialist firms not being able to make good on these bets, right? And that's really what they were at that point, is just that they were bets. That was kind of the first introduction of the Fed put. It played a significant role in halting the panic associated with 87. But interestingly enough, I would actually say that wasn't really where the activist, it may have been where it was born, but that was kind of untouched for a period of time. Like the Fed didn't really play that active of a role in markets, at least on my analysis, until we came to kind of the LTCM type dynamics. And at that point, least
the tequila crisis.
The tequila crisis in Mexico, yep.
Orange County went poof in the same year. So, but yes, long-term capital management.
Well, with long-term capital management, something changed on a structural basis, right? So the Fed suddenly began focusing its interest rate activity, its interest rate movements, on not fighting inflation, which is what it had done since basically the 1970s. Instead, it shifted to trying to manage the expectations channel by preventing collapse of asset prices, right? So one of the challenges of the 1970s and the breakdown, and so now you have to go all the way back, to that time period. If you think about the 1970s, we kind of had this very simple mechanistic view, which was, this sort of Keynesian or post-Keynesian view that, well, we could manage demand by the government increasing taxes, increasing spending. We could keep unemployment low. We could keep the economy going, et cetera. And in the 1970s, many of those relationships broke down, or at least indicated failure, right? So the Phillips curve, for example, which is supposed to govern the relationship between unemployment and inflation, we simultaneously had high unemployment and high inflation, which is not supposed to happen, right? The demand component. And so the Fed very much had to shift to fighting inflation, or at least what they thought they were doing was fighting inflation. And that changed in 1998. And it became very clear in terms of the relationship of interest rates and asset prices that what had been a phenomenon of taking the punch bowl away, to use the Warren Miller reference, the Arthur Miller, I'm sorry, reference. Warren Miller is a ski documentary maker. You took away the old reference was you would take away the punch bowl by raising interest rates and reducing speculation. Post 1998, it became when a negative financial event occurred, i.e. financial conditions tightened, the Fed would respond by cutting interest rates to try to facilitate borrowing, to try to facilitate lending activity, et cetera. And that was a very substantive structural change that occurred in 1998. It's very clear in the data. And in my view, that's kind of the origin of much of what we refer to or bemoan as the activist Fed.
Okay, well, I'll have to send you a very boring paper I did about 1998 and long-term capital management when I was inside the Fed.
Yep.
So if you can get through compliance at the Federal Reserve, it's not going to be too, it won't keep you up. So,
okay.
So 1998, at that time, where was Vanguard? Where was passive investing? Where was there even an ETF back then? I don't think so. But take us back to 1998, 1995, that era.
So if you go back to that point, and if you're thinking about the growth of passive investing or where Vanguard was, right? So circa 1994, 1995, Vanguard and all other index providers are less than 2% market share, right? So very small relative to the overall investment universe. Vanguard was obviously the leader even at that point. But two important things happened in that time period. The first was in 1994, the Leavitt administration of the SEC did a giant study on derivatives, because the challenge that you had prior to that point was that mutual funds were restricted from using leverage in most situations by the Investment Company Act of 1940. They were also prohibited from buying securities that could have a first claim on assets, effectively leverage, which included derivatives. And in derivatives are also included futures. So the Leavitt administration did a giant study in 1994 evaluating the risk of allowing mutual funds to use derivatives, as in particular futures is really what they were focused on, less on puts and calls as we think of derivatives. And the reason that this appears to have had a lot of impetus is tied to the challenges that Vanguard and others, even at that small size, were having in maintaining their index provider focus, right? So they began to experience what's called tracking error, where you would issue an S&P 500 fund. You're supposed to very closely track the index, but if you're not using futures to track that index, you're forced to go out and try and buy every individual security. Some of those securities are much less liquid than others, and by participating in that manner, you're influencing the price of those securities in your portfolio relative to the index. That then means that you have tracking error, and that's the kiss of death for an index provider strategy. And so that whole SEC investigation of derivatives in 1994 appears to have been done to facilitate index providers beginning to use futures and address this issue of tracking error. And when that happened, it led to an explosion of the utility of futures, right? So as an equity market participant in the late 1990s, while most people were very focused on the dot-com dynamics, the single most interesting thing that was actually happening was the explosion of volume that was going through futures and beginning to go into index funds, which grew rapidly from kind of 2% to about 10% over the next couple of years.
So, so that would be, if you will, that watershed moment. Was that the big bang for passive investing, or was there more market history to come? Was passive investing, was there a moment later in time that it became the end all be all? Because And actually at the time, I mean, one of my biggest clients at the time was trading massive spider futures, just massive hedging his portfolio. I mean, the world was blowing up. I mean, because I was on Wall Street during the late 1990s, and you've got this other guy slinging it around with SPYs every day, in and out.
Yeah.
But was there a different catalyst? Was there a big bang moment for passive investing?
So that was one of the key catalysts, right? So that period, 95, 96, the beginning of what Greenspan referred to as irrational exuberance. In my analysis, this is largely tied to the growth of passive investing and the use of those futures. And just very quickly, the reason why that happened was because the indices were improperly constructed at the time. They were built on what's called a market cap weighted basis, which means that you're trying to buy shares in proportion to the total shares outstanding. The unique feature of the 1990s was that you had a number of large market cap, low float companies that had what we used to refer to as high levels of insider ownership. And so these would be companies like Walmart and Microsoft and Cisco and Dell, right? When the index providers were trying to buy these in proportion to their market cap relative, rather than the float adjusted weightings that were available, the actual shares that you could have purchased, it meant in companies like Microsoft or Dell that you were trying to buy twice as many shares as were actually available. If you try to buy twice as much of something, you're going to cause it to outperform. That led to the dot-com cycle. Now, I sat outside this as a value manager and basically watched some components of this. Similar to what we're seeing today, that construction of indices led to dramatic underperformance of value investing because you were not basically benefiting from this. So they tended to be older companies that had all of their shares outstanding, et cetera, right? And they also did not fall into the technology space. So there became some very serious disconnects that occurred. That was kind of the first part of the growth of index investing, was the facilitation of that. The second thing that happened was in 2004, 2005, they changed the structure of the indices. And then a very important, but somewhat innocuous change was made in the 401k space, which was the introduction of what were called qualified default investment alternatives. And this is part of the Pension Protection, I think it's called the Pension Protection Act of 2005. The idea was very simple, that up to that point, if you went to work for a company and you received a 401k and you saved money into a 401k, there were two things that people were worried about. One was relatively low levels of participation in 401ks. That was a function of you as an employee had to make a decision when you joined a company that you were going to participate in the 401k. So it was an active choice. In 2005, they changed that. They turned it into a passive or the default choice, so that when you went to work for a company, you were automatically enrolled in a 401k unless you refused to do so. So that single change was huge in terms of participation. The second thing that happened was when you used to go to work for a company and get a 401k, you had to actively choose what products you would invest in. If you didn't make a choice, it would just go into a money market fund. And so your money effectively would not be invested. In 2005, that changed with the introduction, as I said, of QDIAs, qualified default investment alternatives, which meant that your corporate HR manager was selecting a fund that became the default. And almost inevitably, that became some form of balanced or passive vehicle. And that was then further changed in 2012 with additional regulatory changes under the Bureau of Labor, the Department of Labor, that switched it almost exclusively to target date funds. And so target date funds have been by far the fastest growing space in the industry. They've gone from not existent in 2003. They literally did not exist prior to 2003. By 2012, they became the default. And today, nearly 80% of all dollars going into 401ks are flowing into target date funds.
80%.
80%. The really crazy statistic is in excess of 60% of 401ks now only have a single vehicle in them, which is the target date fund.
Oh, okay. Since I left the Federal Reserve, I've been doing my own investing, so I'm really happy I don't know about these innovations, shall we say.